managerial accounting, planning and control, variable manufacturing overhead efficiency variance. Now we just took a look at how we calculate the variable overhead spending variance. Now let's take a look at the formula for the variable overhead efficiency variance. The formula is almost identical to that of the direct labor efficiency variance. We compare actual hours with standard hours allowed, and then we multiply that hour difference times the standard rate. So it's the same formula, but again you have to be careful to make sure that you pull the variable overhead rate from your data, not the labor rate. So since it's essentially the same formula, and in this particular example overhead is applied based on direct labor hours, the direction of the variance is going to be the same as that for the direct labor efficiency. We had an unfavorable direct labor efficiency variance, so we should also get an unfavorable variable overhead efficiency variance. So let's do the numbers and see what we come up with. Again, 23,000 actual hours were worked, minus standard hours allowed. Well, since the overhead standard is 7.75 hours per unit, then so will the variable overhead hour standard be 0.75. So 0.75 times the 23,000 units produced. Remember, this is how many hours should have been worked to produce the actual output. So in this particular example, labor hours actual was the same as units produced, but that's merely a coincidence, a function of the numbers. That's not always going to be the case. And then we add dollars to it by multiplying times the $2 variable overhead rate. So once again, 0.75 times 23,000 units is 17,250 standard hours allowed for actual output, and 23,000 actual hours minus that 17,250 times $2 is going to yield an $11,500 unfavorable variable overhead efficiency variance, just as we predicted. Now, what can we say about this? Well, not much, unless if direct labor hours is the true cost driver of variable overhead. In other words, if the variable overhead is indeed incurred for every direct labor hour worked, then this tells us that the inefficiency of labor not only cost us hourly wages and fringe benefits, but it also cost us additional variable overhead resources. So the impact of that inefficiency of direct labor is much larger than just the direct labor efficiency variance indicated. However, if direct labor is not the cost driver, if we're just using that as an allocation base because we've always used it as an allocation base, then this number is not really very meaningful. This doesn't tell us how efficiently we have used variable overhead resources. It is an indirect measure of the efficiency of labor and its impact on variable overhead, but does not tell us how efficiently we've used variable overhead resources. So not a terribly meaningful number, and some organizations don't even calculate either of these variances. They may look at the spending, but can almost pull that from the flex budget. So they may not even look at this. Overall, we want to make sure that we tie back to the Flex Budget Performance Report. So we had a 2,300 unfavorable spending variance for variable overhead and 11,500 unfavorable efficiency variance. So that totals to 13,800 unfavorable variable overhead variance that will be part of the cost of goods sold flexible budget spending variance. Now the final set of variances we're going to look at are for fixed manufacturing overhead.